Welcome to the S2G Summit. We've been gathering here 8 times now, and every year we say sort of observing historic milestones. Another year of volatility. While President Trump, AI, and capital markets have made all the headlines, the planet seems to be headed, in our view, to 2.5 degrees or higher. Since 2020 at S2G, we've been operating under the assumption that we're shifting from an era of moderation to an era of volatility. We've all lived through this volatility. Interest rates and inflation experience historic movements. S&P drawdowns of 20% or more that typically happen twice in 25 years, happened twice in the last 2 years. Shipping rates for 30 years were stable, are now prone to repeated shocks and significant inflation. Commodity prices no longer operate within their range bound. In the past 5 years, we've had the most conflict since World War II. While climate change may not have a singular 9/11 moment, the human and economic costs are going up. Simply put, the last 30 years are not the next 30. What built the current global economy, what built the current global order are being structurally challenged. We are in debt, aging, digitizing, heating, and increasingly fragmenting. These trends are increasingly concrete and not clay. So modern portfolio theory has shaped the last 30 years of portfolio construction. Under this construct, risk isn't about individual assets, but managing risk through diversification. Quantitatively, building portfolios are an expected return, volatility, and correlations. This led to the growth of ETFs and influenced trillions of assets under management. However, modern portfolio theory was built in this era of moderation. The theory really started in 1952, but scaled in the 1980s. It was underpinned by low and stable inflation, minimal GDP volatility, 40 years of bonds rising, and the negative correlation between stock and bonds that led to the popularity of the 60-40 ratio. In the era of volatility, we do not believe that modern portfolio theory works on its own. Correlations are breaking down. Return distributions of volatility are more unpredictable. Return per unit of risk, known as the Sharpe ratio, are compressing. Modern portfolio theory isn't dead. It's just not sufficient on its own. We need to move from static to adaptive models. Diversification not by asset classes, but by risks. And by the way, founders and operators have always lived in a post-modern portfolio theory world. So what? Our view, risk needs to be redefined. Diversification is now a strategic choice. And the future, we think, belongs to adaptive portfolios and adaptive companies. And we're going to talk about what the 21st century version of adaptive is, we hope, in the sessions to follow. So the past 30 years, the investors could ride basically a passive data, benefiting from sort of stable macroeconomics and broad economic growth. That playbook is now volatile and fragile. It is conditional, it is crowded and concentrated, it is even more correlated. In our view, alpha is not just about outperformance, but really about adaptability. Adapting to nonlinear shocks, new structural forces, and exploiting market dislocation. The search for alpha and beta is rooted in human history. The notion of anchoring on the current system, beta, profiting from shift, has endured for over 2,000 years. Humans have crossed the Rubicon, sailed around the world, made electricity dance, all in search of shifting the predominant paradigm. Beta's been also more than a baseline paradigm. It's been about an embedded belief of how the world works, that interest rates will be low, that trade will be open, that demographics will support consumption. While we need to understand the current beta to know kind of what game you're playing, if you don't see the shifts, if you don't see the changes, investors, operators, and institutions can get caught with excess risk and poor returns. The last 300 years of alpha and beta have demonstrated this. It has demonstrated this need to embrace adaptation, embracing the dominant trends, but also seeking outperformance. The last generational shift that occurred in our view, the last sort of paradigm adaptation that occurred was in the early 1970s. It laid the foundation for the modern world. The Nixon shock changed the price of money. Gold, so the dollar was set free from the gold standard. The Nixon to China moment spurred globalization and free trade. We saw the beginning of Moore's Law and the acceleration of the greatest demographic dividend in human history. Moore's Law was sort of the drop in transistors that allowed for billions of chips to be on a single chip. It allowed for a shift from room-sized mainframes to PCs to then smartphones. What the steam engine was for the Industrial Revolution, the drop in transistor costs was what the digital revolution. The 70s began the greatest growth in global middle class in history, from 500 million to 2.8 billion. The Nixon shock convinced folks that debt was cheap and easy. Global debt grew from 3 trillion in 1970 to over 300 trillion today. This jet-fueled levered asset classes like private equity and beyond. Nixon's China embrace and their entry in the WTO redefined globalization. It lifted billions out of poverty and changed supply chains. World trade as a percent of GDP went from 26% to 61% from 1970 to 2008. Investors that didn't embrace these shifts lost returns and lost their company. Technology, U.S. equity capital markets, levered assets all outperformed. The emerging markets came of age. Companies that embrace these shifts create alpha. Private equity AUM grew 100x. Companies that embraced emerging market consumers outperformed. Enormous wealth was created from these 4 trends. So how do we identify sort of the alpha of the next 30 years? That's really the question that I think we're here to talk about for the rest of the day. We think it's about observing regime shifts, so really at the systems level. It's embracing the difficult, the capital-intensive, the volatile, being open to patience is very much an art, having the courage of non-consensus, and exploiting structural mispricing. But even if you saw the shift to PCs, the shift to mobile telephony, leaned into globalization, had the courage to be different from the groupthink, beta can take longer to catch up. Triggering seismic changes to beta takes more than early conviction. Beta changes, in our view, with 5 forces: economic crisis, political policy shocks, geopolitical shifts, technology breakthroughs, and culture and the redefinition of values. Each economic crisis has losers and winners. Political shocks tremor beyond capital cities and capital markets. Geopolitical shifts, not just supply chains, but economies. And productive innovation has systemic impacts. In my view, culture is upstream from politics and economics and often drives change in consumer patterns and beyond. The early 1970s saw 4 forces that created trillions of wealth and laid the foundation of economics and politics for 50 years. We believe that from 2020 to 2025 is a similar convergence of historical catalysts, on par with what happened in the 1970s. The last 5 years has, we think, set us up for the next 30. These 4 drivers, in our view, sort of will shift our beta, and there's opportunity to create new alpha. AI, the shift from CPU to GPU. Geopolitics, from unipolar to multipolar. The monetary regime, from the shift from the dollar world to an uncertain price of money. And finally, a shift from 1.5 degrees to 2.5 degrees. These 4 drivers on their own have enormous implications for investors and companies, but the systemic impact of the 4 together offer massive risk and massive opportunity. Taken together, we believe that this means entropy. The divergence between the bull case and the bear case is profound. Universal high income or the end of humanity. That is our agenda, not the end of humanity. It's why we've gathered today to learn and explore, sort of building for what's coming, not what's leaving. And so these are the four sort of talk tracks that we've set up for today to really explore these forces, and not just at the individual level, but how do they impact the systemic? And how does that impact investors and company builders? Ranveer, David, and Sunit are going to talk about AI. Chris, Damien, Julia, Gail, and JB are going to talk about geopolitics. Demetrius has the enviable task about talking about the price of money. And Prague, Ashby, Spencer, Barney, Matt, and Gary are going to talk about climate adaptation. Let's get started.